A very good evening to all the West Bengal Civil Services aspirants. Today we are here to discuss a very vital topic of your Indian economy paper, your paper 5 rather, where you have a combination of your polity plus Indian economy. So, and plus this topic which I'll be dealing today is very important for your prelims also, because every year we see 3 to 4 questions coming from national income. Okay, national income is a very is a separate topic altogether, where you will be seeing what are the fundamentals you have got to clear before approaching this topic, and how once you understand it, once you are done with the concepts, how easy it becomes for you. All of a sudden when you see some questions on GDP and NDP and national income, most of the aspirants tend to get confused, how to go about it, what should be the how to solve such questions, should we mug up equations, and these are the questions which come to mind. Okay, but after doing this topic, after doing this discussion with me, I think I will be able to help you guys come out with that disturbance and confusion about this topic, and help you approach these questions in a very confident way. Because after towards the end of this topic, after completing this topic of national income, I will be taking straight away mains questions, not only prelims, the mains questions, because that will give you enough confidence that yes, I am in a position to cater to this topic. Okay, so in this series of dealing with paper 5 Indian economy topics, this is my very first topic which I will be dealing today. Okay, national income. So we'll be proceeding it with it, and as you can see on the screen, this is your part of paper 5. Okay, mains paper. Because see, as you all know, it's a mains come pre-preparation. Okay, so if we deal with the mains in the right way, in the right strategy, your prelims will be very smooth. Okay, so straight away we'll be going to that part. Okay, before we go to the main topic, I want you guys to understand some few basic terms. Okay, these basic terms are important so that it would help you understand the language which is further mentioned in the definitions. Okay, this would make it quite easy. Okay, so straight away we go to the first. These are the basic terminologies. Okay, number 1, goods. Goods, very common. What is goods? The day to day things which we use in our life. Okay, anything, be it your pen, be it your paper, anything, all of this are your goods. Okay, be your pen, okay, pen, paper, anything, your pen, your mobile phone, anything, whatever you are using in your day to day life, all of it comprises goods. Okay, so anything which is giving you any kind of utility, which is satisfying your want, is a good. Okay, so this is okay. Goods are anything which we use in our day to day life, which has a purpose and which has a price. Because for all these things you pay a price. You do not get anything free of cost. Do you get it? No, everything has a price. So anything which has any physical object which satisfies your demand available in the market and provide you utility are goods. Okay, so goods are anything, physical object which satisfy your day to day wants. Okay, now after this I have devised a classification. Okay, that all of you know what are goods, but there is a difference between final goods and intermediate goods. Okay, because see, these are the words which you will be getting in the national income definition. Okay, so before that you should be clear about what are these two types of goods. Okay, the very first classification, final goods and intermediate goods. What are final goods? Final goods are the goods which you are using in your hand, which are there in your hand at this point of time. For example, pen. Pen is a final good. Over here I have given the example of bread. Bread is a final good because you have it in your hand, you consume it on a daily basis. Anything which is ready to use, is a final good. Okay, anything which is ready to use, which you are using, consuming yourself, is a final good. Okay, fine. So that is final good. That means good, what I said you, is a final good, what you would understand. Okay, but now there is another good which is an intermediate good. What is an intermediate good? As the name itself says, intermediate goods are those goods which are used as a raw material. Which are used as a raw material for making what? For making final good. These are the raw materials which are used in making the final goods. For example, if I take the example of pen, what is the raw material which is used in making the pen? You have your, suppose you have the plastic which is involved, the body, okay, then you have the ink, okay, you have the ink, you have the plastic. So what is all of this? These are intermediate goods, okay. So final good is that good which is in your hand, which you are using, okay, and intermediate is good is those goods which is used in making that final good, which act as the raw material for making that final good. For example, if you take the example of bread, if bread is your final good because you are consuming it, then what is the intermediate good in bread? It is the wheat. If it is a wheat bread, if it is the flour, if it is a flour bread, okay. So these are examples. These are the basic difference between intermediate good and final good. Intermediate goods are used in the process of making a final good, okay, and final goods are those goods which are ready to consume. So this we are done with the first classification, okay. Now come to the second classification. Second classification is consumption goods and capital goods. Again, consumption goods are those goods which you are using directly for your consumption. Example I have given earlier, bread, milk. Again, the final goods which you are using, those are only consumption goods, because consumption, who is doing the consumption? The consumers, okay. So consumption goods are again those goods which are the final goods used by consumers like you and me. And then capital goods. What are capital goods? These are the goods which help in production. Like intermediate goods, they were the raw materials for making final goods. In the same way, capital goods are those goods which are helping in the production of consumption goods. For example, plant and machinery, okay. Because these are the things which you use. Capital goods are those goods which are used to process, and produce the final goods, okay. For example, if you are producing anything in your factories, okay, if you are making anything, okay, tire factory or anything, whatever it is, what you require? Don't you require the plant and machinery to produce and manufacture? So what are those goods? Those goods are your capital goods, okay, because they are the fixed assets. They are the assets which, fixed assets are subject to depreciation, okay. These things accounting students would understand well, okay. So capital goods are those goods, they are fixed assets which are used in the process of manufacturing what? Consumption goods. Capital goods are those goods which are helping in production of consumption goods, okay. So by now you are very clear after this what are goods, what are final goods, what are intermediate goods, what are consumption goods, and what are capital goods, okay. Now we would proceed. Services, okay. Now what are services? Goods you all have understood what are goods. Now it is the services, okay. Now services are non-material things. Like goods, I said you, anything which you can handle, pen, paper, book, anything, those were goods. Now what are services? Services, can you handle? Can you touch these? Banking services, teaching services, no. So services are non-material things, okay. Or rather you can say non-material goods are services, okay. So these are the things which are very much present, but they are not tangible, okay. You cannot touch them, you cannot feel them, okay, but they do exist and they are a very important part of the economy, okay. So goods were things which you can touch, which has utility. Rather, services also have utility. Those are tangible in nature, and services are non-material things, okay. You cannot see or touch them, okay. So example, banking services, teaching services, insurance services, everything, your hotel services, all these are services, okay. So two things are very important in any economy. Two things are very important in any economy. One is your goods and the other is your services, okay. So by now you know what are the goods and what are the services, okay. So this I told you so that the definition of national income includes both these terms. Okay, so now you have a great idea about it, that what is the basic difference between goods and services. Okay, now we would proceed. Now, what is national income? This is our main topic. What is national income? National income is the final value. National income is the final value of all goods and services produced in an economy over a given period of time. Okay, national income, it is, as the word itself says, nation's income. Nation income means your nation, your country. Okay, that is India. So nation, your nation, the nation's income, the total income of the nation. Like for example, you, me, all, if you all are students, fine, some of you are even working. Okay, so all of you have an income, fine. At the end of the month you get something from the company or the organization where you work. So that is what? That is your individual income, right? That is your individual income. Now these individual income of the whole population, fine, if you multiply individual income of the whole population, what you get in return is the national income, fine. So rather what I am saying is that the income of the entire nation, okay, what different people are earning, okay, that is your national income. Okay, so what is the process of doing that? You will not sit and calculate each and every individual. We have population of 135 crores. Okay, so it's not possible to sit and calculate income of each and every individual. So what we do is that there is a process. Okay, there is a method to calculate national income. So what is it? We will be discussing now. Okay, so national income, it is the final value of all goods and services. The earlier slide, what did we discuss? Goods we discussed services. Okay, produced in an economy over a given period of time. Final value. Final value means what? We have just discussed. Final goods and intermediate goods, that means what we are talking about? Final goods. And not intermediate. Why? So I will tell you now. See, for example, if you have calculated the value of bread is produced in the economy, bread is produced, so the value of bread you have to take into account when you are calculating the national income. So just think once, if you are taking the value of bread, do you need to take the value of flour also, which is used in making that bread? Won't it be a process of double counting? Won't it be a process of double counting? Think again. See, as I said you, bread is the final product and flour is the intermediate product, because flour and wheat is used in making that bread. So if you are taking the national income, as I said you, we have to take into consideration only the final goods. So definitely you will take the value of only bread and not the flour. Why? Because if you take the value of bread and if you take the value of flour also, what would happen? Flour value is already included in the value of bread, na? Because if the bread, the manufacturer, he will definitely take into account the value of flour, na? To calculate the total cost of production of one bread. So if he has already taken it, then why will you take it again? If you do that, then this would lead to double counting, which we don't want. Okay, that is why national income always is the final value of all goods and services and not the intermediate value. Okay, that is the reason why I discussed with you earlier what is the difference between final goods and intermediate goods. Okay, so now it would be very clear to you that why we only take the final goods and not the intermediate goods. Because if we take the intermediate goods also, it would resort to double counting, which we don't want. Okay, so to make our process easier, we only take the final value of all goods and services produced in an economy given period of time. Okay, in our case it is 1 year. Okay, we calculate it for 1 year. Okay, so final value of goods and services produced in an economy over a given period of time. Okay, now you can over here see the equation. What is it? The equation is consumption expenditure. As I said you, Consumers, investment expenditure. This is this actually we are talking about the shares. Over here we are talking about the shares. Okay, that is also an expenditure. Then you have the government expenditure, because see, consumption expenditure is made by you and me. Investment is also done by us, especially the business houses. And government expenditure is the expenditure done by the government. Okay. So all these three expenditure you have to take when you are calculating the national income. Okay. Plus X minus M. What is X? X is the export. Okay. Export, what you are, the things which we are sending to other countries. Goods manufactured in our own country which we are sending abroad. Okay. And import is things which we are bringing from other countries. Okay. So to get the national income, what we do is that we reduce the imports. Okay. Because what we want is that we want, see, the say produced in an economy. Okay. The definition says produced in an economy. So for that you have to reduce the imports, because imports are, these are the goods produced in other countries, right? So when you are calculating your own country's national income, you have to reduce the imports and you have to add the exports. Okay. Because exports are manufacturing done in our own country. Okay. And national income means income of our own country. Okay. So this is all about national income. So this is the, this is the process of calculating national income. But to do so, we have some indicators. Okay. These are the indicators which we use to show that, which measure is the best. Will be, these are the 4 measures which we take, okay, to calculate national income. So slowly, one by one, we'll be discussing all of this, all these indicators, and why, one is better, above the other, and, what we choose, at the end. So all of this will be clearing in slides to come. Okay. So till now we have done what are goods and services and what is national income. Okay. Now we would proceed. Fine. So now we come to the very first indicator, or rather the most important indicator. This is what? Gross domestic product, GDP. All of you know this, all of you hear in the newspaper every time, GDP, GDP, GDP. Okay. So what is it now? We'll study. First of all, GDP is the gross domestic product. Okay. Fine. So as you have said, see, this is indicator of national income only. Okay. These are indicators of national income only. So definitely it is value of final goods services produced in a country in a year. Okay. Same definition which we have studied earlier, and same equation which we have studied. Okay. Now, what is just the thing why it is different? What is GDP indeed, and why it is different from GNP? This is the main agenda which we got to study. See, as you understand with the name itself, domestic. Domestic means what? In our own country. Okay. In our own country. That means this is location specific. Okay. GDP is location specific. That means you have to take into account only things produced in our own land. Okay. Only price of goods and services availed or manufactured on our own land, that is domestic. Okay. So in this, what is the thing which I want to explain you guys is that all goods and services produced in India. This all of you know, but mark this, either by an Indian or any other foreigner. Okay. Because the law says what? In our own country. Okay. In our own country. So you have to keep, see, Indians are there, you all agree. Yet I have discussed earlier also. National income generated by our own people. But over here in gross domestic product, we also take in account foreigners' income. Foreigners, which foreigners? Foreigners working in India. Okay. Because I said you, domestic product. The law says domestic product. So if any other, other country or, other companies which are not, based out of India, or, if they are working in India, if they are manufacturing in India, that too will also be added in our domestic product. Okay. Why? Because the law says, the gross domestic product says that anything which is manufactured in our own land, anything in our own land, irrespective of producer, irrespective of producer, be it an Indian or a foreigner. It doesn't matter. It doesn't matter. As long as it is produced in our land, as long as it is produced on our own territory, it is included in the gross domestic product. Okay. So just keep this in mind. Gross domestic product means anything produced on our own land, be it Indians, be it foreigners. It doesn't matter. So just to remember this much, Indians in India, that would be counted for sure. Over there is no confusion, but over here foreigners in India is also included. Okay. So GDP is Indians plus foreigners in India. Both of their income together if we take, then we arrive at gross domestic product. Okay. For example, the Samsung products which you are using, okay, Samsung is not an Indian company, right? But when you are calculating the income of our country over there, their production is also counted. Okay. Because they are produced within our own country, irrespective of who is producing it. Okay. So the crux is gross domestic product is anything produced on our own land, irrespective of who is producing it, be it Indian, be it foreigner. For example, in an MCQ, if you get gross domestic product is what? Does it include foreigners in India? Then it has to be a right option. Don't think that if it is GDP, foreigners are excluded. No. In GDP, you have foreigners' income included if they are working in India. Okay. So I think now it would be very clear. And even if there is some, loopholes, when we do the MCQs, it would be very much clear. Okay. Next. See, we have done gross domestic product. Now another difference. Gross domestic product at factor cost and gross domestic product at market price. Now what is this? Before that, I would try to explain you guys what is factor cost. See, factor cost means cost of factors of production. Okay. That means the total cost, or rather you can say that just the cost of production. Okay. The total cost which you have incurred in manufacturing anything. The total cost which you have incurred in manufacturing anything. Okay. That means, for example, if any of you are into any kind of business, okay. For example, you are producing anything producing shirts or anything, shirts, trousers, anything. So what is the cost of production of one shirt in your factory? What is the cost of production? For example, you sell a shirt at 200 rupees, okay, but your cost of production is 100. That means the total cost incurred in making that product, that is your factor cost, and 200 is your selling price. Why? Because over here you have lot of other things added. You have the taxes added, you have your profit added. Okay. So that, if you exclude that, only I am talking about the cost of production. That means the amount of cost which you have incurred in producing any product. Okay. That is your cost of production. So factor cost is your total cost of production, means how much total cost you have incurred in producing any anything. So these factors of production are basically 4. And all of you would agree to that. Land, definitely land. Why? Because whatever you are doing it on a piece of land, fine. On a factory you have built over there, or any kind of any plant you have set up, anything whatever you have done. So that is your factor of production, because over there you pay a rent. Okay. Next, your labor. You need labor to manufacture anything, and in return what you give them? Wages. Again, capital. Capital is the initial amount which you require to set up any business. You need that definitely. Without that you cannot do anything. So that is your third factor of production. And your fourth is entrepreneurship. Entrepreneurship is the people, or the person who starts any business. Okay. So these are the 4 factors of production which you require. And against them you pay these things. Okay. For example, for land you pay rent. For labor you pay wages. For capital, for example, capital is something, if you have taken a loan, okay, from any bank, what do you pay in return? Interest. You got to pay them interest. That is why they have given you loan. So that is capital, your initial amount of starting any business. And last in entrepreneurship. Entrepreneurship is the person who initiates the business, who takes the risk. He is the person who takes the risk to start any business. Why he does that? To get profit. Because at the end of the day, the motto of any businessman is to earn profit. That is why he is into business, right? So cost of all these factors of production, after taking the cost of each one of them, what amount which you get, that is your factor cost. Okay, that means the total cost of production which you have incurred before the product comes into the market. Okay, that is your factor cost. Okay, so if you are calculating the final value of goods and services at factor cost, that means you are taking all these things into account. Okay, so factor cost you have understood. Now we would go to the market price. What is market price? And then we would come to GDP at factor cost and market price. Okay, so just simple factor cost refers to the total cost of production of anything, okay, of any good and service. Okay, and you just keep in mind these 4 factors of production and their factored incomes. You might get in your MCQs. Okay, you have to remember, because these are the 4 factors of production and these are their factor incomes. Next. Okay, after factor cost, we would do the market price. See, now market price is what? What is market price? As you all know, market price is a price of any product in the market. Okay, so as I said you earlier, your cost of producing a shirt is, manufacturing a shirt is 100 rupees, but you sell it in the market at 200. Why? Because that 200 is what? That 200 is your market price. Okay, because you need that, because that is why you are into business. Otherwise you won't get go into business. Right? You cannot have like for example, cost is equal to selling price. You cannot do that, no? Otherwise you will not make profits. Okay, so this is the price which the customers actually pay, market price. They don't pay the factor cost. Why? Because you have to add the taxes and subsidies. Okay, because the government asks you for taxes. So how do you get that taxes? You will take it from the consumers. Okay, you will not pay it from your own pockets. Okay, so when you take into consideration the taxes and the subsidies, what you arrive at is market price. So the simple equation is factor cost plus indirect taxes which you pay to the government minus subsidies. This too is given by the government to you. These are advantages or benefits, you can say. Taxes, all of you know. Taxes are the taxes which you got to pay to the government. Okay. But what are subsidies? These are the benefits. Okay. These are the deductions which government give you in the form of tax or monetary or cash. Anyway, they can give you any kind of benefit, subsidies, so that you produce more of that product. Okay, to make that product available in the market for more for more and more people to get the benefit, to get that product, that supply. Okay, for that government gives subsidies. Okay, they give subsidies to manufacturers so that they produce more of any product. Okay, so what is the when you arrive at the market price, what you have to do is that you have to add the indirect taxes. The factor cost you all know, we have studied. You have to add the taxes and reduce the subsidies, because these are the benefits. Okay, the benefits you have to reduce, and the taxes which you are paying to the government, that you have to add. Okay, so when you do that, you get the market price. Okay, this is a very important, this is the most important part, because mostly you get questions from here. Mostly you are getting questions from this slide. This is very important slide, market. So market price is what? Factor cost plus indirect taxes minus subsidies. Okay, or simply you can say net indirect taxes. Means indirect tax minus subsidies is what? Net indirect taxes. You might get this in the question, you might get this in the question. So just remember, no need to mark up, just simply remember factor cost is cost of production, but to arrive at market price you got to pay taxes to the government, so that taxes you will add, and subsidies are the advantages given to you by the government, you have to deduct that. Okay, so this is simple. Market price is factor cost plus net indirect taxes. And other way if you do, Factor cost is market price minus net indirect taxes. So don't mug up, just try to understand and remember it. Okay. So this is the difference between GDP at factor cost and market price. You can see it now. Market price at factor cost plus net indirect taxes, and factor cost is market price minus net indirect taxes. Okay. Very clear, I assume. Now we would move ahead. Now we come to another difference, real GDP and nominal GDP. Okay. Now what is this? Nominal GDP is the simple GDP which we have studied, just now, GDP at market prices. That is the market value of final goods and services, not the factor cost, mind it. So GDP at market prices, nominal GDP. Remember it for your MCQ also. And other is GDP at constant prices, which is the real GDP. Now the main thing which you got to understand over here is that real GDP. Okay. So what is real GDP? Because what happens is that GDP at market prices always had inflation included in that. Because see, what happens is that every year, from year after year, the prices of goods and services increase, right? Increase because of inflation. The price of things which are today might not be the same after 2 years. Okay. Anything you can take, starting from your fruits, vegetables, anything, whatever, they tend to rise, over a period of time. So what happens is that, so whenever you are taking this, market prices, it always includes that inflation into it. It does not exclude that inflation element. So because of that, the things, for example, your GDP might see inflated, okay, but it is actually not. It is not increased in real sense, because it is inflated because of the element of inflation into it. Okay, that price rises because of the persistent rise in the level of prices. It is not because of any increase in productivity. Okay, because what we want is that we want increase in productivity, okay, which is actually not taking place. Okay, so that is why GDP at market prices does not give you a real figure, real picture. Okay, for example, you can see your common day-to-day example. For example, your salary is 20,000, okay, but your expenditure is suppose 10,000, fine, but your salary increases to 30,000, and your expenditure also increases the same level. Okay, so what would happen is that in that case your savings won't help you in any way, because what is happening is that your salary is increasing, but your expenditure is also increasing simultaneously. Okay, because see, the things and the articles which you are purchasing in your day-to-day life, if their price also continuously increasing and your salary also increasing, you're not able to take the benefit of that saving. Why? Because of inflation. Okay, so this is it. GDP at market prices include it, the articles and the goods and services include that price of inflation. Okay, but real GDP, we have to adjust that inflation to get the real GDP, to check that yes, have we increased our productivity or not? Have we increased our productivity or not? Okay, for that what you require? You require real GDP. Okay, which is always calculated in reference to a base year. Right now it is 2011-12. Remember this. The base year for calculation of real GDP currently is 2011 and 12. They are thinking to make it 2017-18, but they have not done it yet. Okay, so what is this? When you are adjusting the inflation in calculating GDP, if you are adjusting inflation, that means the effect of inflation is you are excluding that effect. What the end product we are getting is the real GDP. Okay, so this is value of output economy adjusted for price changes. Okay, a simple example I can give you to understand this better. For example, in 2019, a car manufacturer is producing 50 cars. Okay, 50 cars he is producing, and price of each car is 1 lakh. I am just assuming it. Okay, just assuming it. So the total price of 50 cars is 50 lakhs. Okay, now in 2020, what does he do is that he is producing 40 cars. He is producing 40 cars. Okay. Now the price of each car is 1.5 lakhs, you say. It is 1.5 lakhs. Now the total amount comes to 60 lakhs. 60 lakhs. Okay. Now what would see? In real sense, what you see? Yes, it has increased from 50 to 60. It has increased from 50 to 60 from 2019 to 20. Fine. That means the amount is increased. But in real sense, if you see, has the units increased? No, it hasn't. It's reduced. The productivity has rather reduced. Okay. And this 1 lakh to 1.5 lakh is what? This is inflation. This is inflation. This is your inflation. Okay. So this is the point which I am talking about, that this inflation, inflated value giving you a price is, this is your nominal GDP. This is your nominal GDP. But in real GDP, what we would do is that we would adjust this inflation. We would adjust this inflation, because in real sense, the productivity has decreased. But the total value, what does it show? That from 50 lakhs we have increased to 60 lakhs. When you see the picture, it is like, yes, you have increased. The final value has definitely increased, but in real sense, it has not increased. Rather, the productivity has decreased. Earlier, he was producing 50 units. Now, he is only producing 40 units. But the total sum is increased because of the inflated value. Earlier, it was 1 lakh. Now, it is 1.5 lakhs. Okay. So, this is something which we have to ignore. So, for this, GDP at constant prices, real GDP, it gives you a real picture. It gives you a more accurate measure. So over here you can see real GDP is a more accurate measure, as the name indicates, because it helps us in understanding our economy is moving ahead or growing in real sense. So real GDP is GDP at constant prices, because over here you always do it in reference to a base year, and which currently is 2011-12. Okay. This is important for your MCQ. Just remember this. Now we would proceed. You have completed your GDP. Now we would come to the NDP part. Okay. This is very easy. See, whenever you have to come from G to N, the only thing which you have to keep into mind is depreciation. Gross and net difference is always depreciation. Okay. So what is depreciation? I have given here an example. If a value of a car is 5 lakhs and it has a shelf life of 10 years. Okay. For example, 10 years is the shelf life. So depreciation is 5 lakh divided by 10, that is 50,000. In other words, what you can say is that depreciation is a wear and tear of the asset. For example, if you are using something for a period of time, it tends to wear out. Okay. So that amount which you calculate, okay, that you also, every year how it has been, the value is reducing. That is your depreciation. Okay. So depreciation is something which you have to take into account. So if you remove this depreciation, because GDP includes depreciation, okay. So from GDP, if you reduce the depreciation, what you get is net, okay. So NDP is GDP minus depreciation, okay. So this is a net concept, this is a gross concept. So this is a more perfect measure. If you compare between GDP and NDP, NDP gets you a better picture because it is a net concept, okay. So just remember, net and gross, the difference is always depreciation. Nothing more to explain in this. Okay. Now come to important thing. We have done GDP. GDP, what I said you, the moment I started it, I said you GDP is location specific, okay. That means domestic territory, whatever it is produced, be it Indians, be it foreigners. Now GNP, what is GNP? GNP is who produces it. Who produces it? Over here, not the territory. Territory was GDP. So for example, it has to be produced by Indians. It has to be produced by Indians only. over there I said you location specific irrespective of producer. Over here producer is important. That means Indians has to produce it irrespective of territory. Irrespective of territory. So simply you can understand it has to be produced by Indians. So even if Indians are working abroad, their value is included in GNP, but not in GDP. Why? Because GDP was territory specific and GNP is producer specific. So Indians in India is common in GDP and GNP. Nothing to worry about that. Just that you have to add Indians abroad. Okay. So Indians abroad plus Indians in India is your GNP. Okay. And NNP is GNP minus depreciation, because I said you GNN, the only difference you have is depreciation. Anywhere, anything you get, gross and net, just blindly you will put depreciation. Okay. So since we have done GDP in details, GNP need not be done in details. Just remember GDP is location specific and this is who is producing it. In that case, Indian territory, even if it is foreigners, you have to include. Over here, abroad, if Indians are working, it has to be included because it is national product. Okay. Now come to the GDP and GNP relation. Okay. Now this is the last and the most vital thing which you got to remember. See, as I said you, GNP is specific of the nationals and GDP is territory specific. Okay. So if you have to arrive from GDP to GNP, what are the deductions you got to make? You have to add the incomes of Indians abroad, because this was not included in GDP. This was not included in GDP. You have to add that. And what you have to reduce? You have to reduce income of foreigners in India, because this was added. Okay. Common simple equation. Anyone would understand this. So what this deduction is called, this income of Indians abroad minus income of foreigners in India, this is net factor income from abroad. Okay, simply. Just to make you guys understand properly, I have written it this way. It is actually net factor income from abroad. So, the equation would be GNP is GDP plus minus net factor income from abroad. Okay, or NNP is NDP minus net factor income from abroad. In our case, in Indian case, net factor income is always negative. Why? Because our income of foreigners in India is always greater in comparison to income of Indians abroad. Okay. That is why our net factor income from abroad is always negative. Remember this. It is always negative. Equation is GDP plus income of Indians abroad. Just think that way, because see, in GDP, income of foreigners in India was included, reduce this, and income of Indians abroad is required in GNP. So just add that. Simple. Just think logically, need not mug up. Okay. So this equation is called net factor income from abroad. This is the thing which you will be getting in your MCQ questions. Okay. In our case, India, net factor income from abroad is always negative. GDP at market prices minus NIT. NIT is what? Net indirect taxes. We have studied earlier, guys. Now this would be very easy for all of you. GDP at market prices minus net indirect taxes. What is this? It is GDP at factor cost. We have just discussed. GDP, or rather what you can say is GDP at factor cost plus NIT. This we have studied is GDP at market prices. Okay. So the equation is GDP at market prices minus NIT is what? GDP at factor cost. All of you understood it well. Next. GNP is equal to GDP plus X minus M, where M means. Just think once now. We discussed a while back, na? In GNP, what we include? In GNP, we have to include Indians abroad. And in GDP, what we include is foreign nationals working in India. Okay. So plus what we have added is Indians abroad. Indians abroad we have added. So what we would reduce from here? What would be M? foreigners in India. Foreigners in India has to be reduced. So in the option, where do you see that? See, income received by foreign nationals from within the country, foreigners in India. Okay, just see the equation, just think what is included in GDP, what is included in GNP, and you would get your answer. Okay, so the correct option is B. Next, this is 2018 question. GDP at factor cost is what? Simple. Indirect taxes minus indirect taxes plus subsidies. We have discussed it a while back. Okay, I need not do it again. GDP at factor cost is GDP minus indirect taxes plus subsidies. Next question. In India, GDP is higher than GNP. Definitely it is higher. Why? Because our net factor income is negative. I said you earlier, because foreigners working in India, they always earn more than Indians working abroad. That is why our net factor income from abroad is negative. Okay, I said you that was very important. See, you have a question also in 2018. Next, this is very simple. National income of India is compiled by CSO, Central Statistical Organization. This is a question which you have got twice. So just remember this. It is done by CSO, Central Statistical Organization. Next. National income calculated at current price in India. Current price means market price. Current price means market price. National income calculated at current price in India has shown a tendency to rise at a faster rate than national income at constant price. Why? What is constant price, guys? It is real. We have discussed. Fine. It is real GDP. Because general price level has been rising faster. What is this general price level? Inflation. We just discussed that example. Fine. That it is increasing. Why? We saw the figure, right? 50 lakh, 60 lakh. It is rising. Why? Because of the inflation. Okay. Per unit price has increased. Not because of the productivity being increased. Okay. So the reason is inflation. General price level has been rising fast. See, if you understand it, you can just get it very quickly. Okay. So, but if you don't understand, this would become difficult. So, please guys understand this, and whatever doubts you face, please put it in the comment section or write it to us. We would definitely get back to you. Okay. 2017 question. Again, the same question. India's national income is compiled by CSO, Central Statistical Organization. What base year is used to calculate per capita income in India? 2011-12. 2011-12. This is something you got to keep in mind. 2011-12 currently. Next. Which is not added in the calculation of national income? Good, fine. See, this is added. Value of goods and services, it is definitely added. Sold value of the old fridge. Old fridge. Why this old fridge would be added? It is a second hand item, right? It is a second hand item. So, second hand goods are not included. Why? Because, for example, the year of purchase of fridge, the year fridge was purchased, in that year national income, it is already being counted. Fine. So, now why it would be added? It would definitely not be added. Now, so always remember, second hand item purchase, these are not included. They are not included in national income. Okay. So, this is not included because this is included at the time of production. The year fridge was purchased, that time it is already included. So, now it would not be included anymore. Okay. Services rendered by the housewife. No, it is not included because these are not monetized. Okay. So, this is not included. So, both B and C. Next. Which of the following is an indicator of financial health of a country? Financial health. As I said you, The economic indicators of national income is GDP, NDP, NNP, whatever it is. So it is GDP. It's not FDI, definitely not purchasing power parity, no. So the answer is only one, GDP. Next question, 2015, India's GDP is more than its GNP. All of you agree? Yes, it is so. Yes. Net factor income is positive? No, it is negative. We have studied. So the option is only one. India's GDP is more, all of you know, because our foreigners working in India is more than Indians working abroad, okay? That is why we always take into consideration the GDP and not the GNP. So with this, we would just end this discussion. These are the most important questions which I thought should be discussed with all of you. After this also, if you face any doubts, you can put it in the comment section or you can write it to us. Okay, you have the mail ID over there. You can get it back